Hello and welcome. My name is Pablo Gonzalez from Picard Angst. I'm here to present you our video about our latest quarterly research report for the third quarter 2025. In this short video, I will give you some data-driven information about some of the most interesting topics about what we have written in our research report. Let's start probably with the most exciting story over the last quarter, and that was definitely precious metals. The gold price surpassed $4,000 an ounce, and also the other metals like silver, palladium and platinum had really strong quarters. One of the main reasons was the heavy demand from central banks. Central banks bought over 3,000 tons every last 3 years, and some analysts expect that the same amount will probably be reached also this year. According to a World Gold Council survey, central banks admitted that they may continue buying gold. On the other hand, you have the gold miners. Gold miners are having also even a better year so far, and this is driven by their operating leverage. Considering an all-in sustaining cost of about 1,500 and considering the prices we have today, you end up having cash margins of over 50%. So if gold prices stay at that level by the end of the year, some of them miners will have a record high margin. Now let's speak about industrial metals. In copper markets, you had some supply disruptions. And with that, we have some analysts saying that we may fall into a deficit already this year, or at the latest next year. And in copper, this is, as you may remember, one of the most important metals into the whole energy transition story. Because usually you need 14 times more metals or industrial metals in general as per megawatt of hour you produce electricity compared to a gas power plant. Also the same is similar for solar panels, where you need 7 times more industrial metals per megawatt of hour compared to a gas turbine. Now let's speak about energy markets. The International Energy Agency is expected to show us into their next World Energy Outlook that under a current policy scenario, the oil demand may even increase, something we have been saying for years. And this is especially relevant because we think that despite having so big renewable targets and pushes around the world, our world is still heavily dependent on fossil fuels. Looking on the shorter term, the current crude oil markets are well supplied, especially driven by the OPEC Plus that increased production faster than expected. And on the other side, we have China. China has been a big buyer of oil over the last couple of months. They are taking profit of the relatively low inflation-adjusted prices. In general, we think we are living in a world where we could speak about energy addition and not only energy transition. As we experience day by day in our life, our energy needs are increasing. Is it driven by mobility, industrial needs, or the electrification driven by data centers where we have a huge increasing demand? We see that we need more energy day by day. So at the end, we will need more energy into the future and probably natural resources in general into the future. Commodities move in long cycles. As you can see in this chart, our Bloomberg Commodity Index, we are in at relatively low levels, despite having a strong year to date. If you look at the chart, you see that it is at a similar level we had at the bottom of the financial crisis. So all in, you can see that we think all this we are speaking about in the commodity world is still underappreciated and underestimated. We invite you to read our quarterly research report, and if you have questions or you need a second opinion on your commodities exposure, feel free to contact us. We are happy to help you. We thank you for watching this video and wish you a nice week.